Hey everybody, welcome back to Two Guys Talking Houses. So today we're going to get into mortgage rates, the Jackson Hole meeting with the Fed. Mortgage rates were actually their lowest of the year this past Friday. And Mark, I don't want to steal any of your thunder. I know you're just chomping at the bit because you're a lender, right? And you got to tell us that rates are the lowest that they've been all year. So what gives? What's causing the rates to come down? What's going on with Jackson Hole? And are they on vacation? Are they just, actually doing something productive?
I was going to say that rates are the lowest they've been all year, but you took care of that, so I appreciate that. No, I'm kidding, but we are excited about that. That was exciting. Friday we saw the best rates we've seen really all year in a long time, and then they came up today. I'm guessing out of boredom. I don't know.
Yeah.
Not much. I mean, it's just a very small market movement that may not even equate to a interest rate difference. It might be, you're paying a little bit more in discount points to get to that rate or whatever it is. So, that's really what we're talking about. But let's talk about this Jackson Hole thing. Have you ever been to Jackson Hole?
No, I haven't.
I have not either, but I hear it's really nice and it's really beautiful.
Yeah.
And back in the 80s, so did Paul Volcker. So Paul Volcker was, they wanted Paul to come to a Fed meeting, and to entice him to go, they knew he liked fly fishing. And so they picked Jackson Hole, Wyoming, because apparently that is, there's excellent fly fishing. There's a national park there, so someday I'll get to Jackson Hole, but I always wondered, like, why Jackson Hole?
And it's because of it's just enticing somebody to go to a meeting.
Right. They wanted somebody to go to the meeting, and a particular individual, they wanted him to go. And so that's how we got here. And they do it, every year since. Now, it's important. This isn't a Fed meeting. It's not one of the scheduled Fed meetings that happen every 6 weeks where they talk about where the rates are going to go up or down. But it is a really good barometer of where the Federal Reserve in general feels things are going. And it's attended by, the Fed chairman, it's attended by the Fed presidents, it's attended by a whole bunch of other people in the industry, who are not, and it's watched for sure because, it's a good indication of what's going to happen next.
So it's not an official Fed meeting, but what is the stated purpose of this particular meeting?
It's really, to talk about policy, to talk about, how things are going, where people expect things to go, where the market is moving, what predictions they're talking. This particular one, they talked a lot about tariffs.
And it seems like the end result of it was good because shortly thereafter, rates are the lowest that they've been. You see the crypto shot up, which it has also, coincidentally shot back down today. You see a lot of the speculative assets kind of rise and fall in big ways with the, what Jerome Powell says or doesn't say. So this is all kind of leading into the next Fed meeting that's coming up in about a month.
Right. October 29th, I believe it is the next one. And
well, hold on, there's not one in September?
Totally made a mistake. So anyway, but yeah, next one is September 17th.
So the real estate agent knew the date and not the LO. Is that right?
See, we're looking so far ahead to see what's going to happen in the future sometimes, which actually kind of ties into why this is important. So, I had a customer tell me the other day, and he's doing a rather large loan with me. He said, well, I think I should wait because I think, the next Fed meeting, which, by the way, is in September, is going to come, rates are going to come down. And I'm like, dude, they already have.
Yeah.
Well, what do you mean? It's like, well, they have come down in response to what they expect to happen in September.
Yeah. A lot of it's priced in.
Realistically, it's already priced in. So you're not likely to get a better deal. Now, if they don't drop in September, now we're in trouble.
Yeah.
That's not good.
Yeah.
But if they do exactly what we expect them to do, then that's great. That's fine.
Which there's an 83% chance is what they're saying on the charts, right?
That's what they're saying on the charts right now. Now, that's been as high as 99%, but some of the things have contributed to that. Maybe some inflation numbers came in a little higher than expected. Maybe there's a narrative about the tariffs. The tariffs are, at some point, if somebody's paying higher prices for something because of a tariff, you would think that the inflation numbers would also go up accordingly.
Yeah.
And so we really haven't seen that per se, but there's certainly a fear that it will happen soon.
Yeah.
And so that's one of the concerns. And then, of course, it's a dual mandate thing with Fed, right? So inflation
jobs.
At 2% and jobs. That's the other thing. And it was interesting. I was listening to a speech that Chairman Powell gave a while back about how there's really not a number assigned to unemployment because it's a moving target to some degree, because there's people that are disabled, they can't work. There are people, the numbers account for, people that are in the military. So if we're at war, maybe that number is different. I mean, there's a lot of factors that play into it.
There's not a hard and fast, like the 2% inflation is that's a pretty rigid number, right?
We're trying to stay number,
at or under 2.
Although, they're starting to like 3 too. So, it's interesting. But yeah, the unemployment numbers have started to rise. So now you've got inflation may or may not be an issue, but they do feel it's appropriate still to loosen the strings a little bit. And so that means a 1/4 point. Now, interestingly enough, if you look at the same probability charts or the dot plot, have we talked about the dot plot before?
I think we have off camera, never
right.
on the show.
So, and if you imagine, like you've got all these Fed presidents across the country, who are different regions, right? And so you say, okay, well, where do you think rates are going to be at this point, and this point, and that point, and that point? And they all tell what they think is going to be. You develop a series of dots along a graph of what they anticipate. And they call that the dot plot. So, and so if you look at that, or if you look at the probabilities, we're still seeing somewhere in the neighborhood of a 1% drop over the next year.
Yeah.
So, and early next year, they're looking at it. So, we'll likely see a drop. I mean, you never want to, jump out there and say, oh, we got a 100% chance of a drop in September, but it's looking really good.
Yeah.
We're likely to get another one before the end of the year.
So then you're at 1/2 point before the end of the year.
These are 1/4 point drops. So unless something crazy happens.
Now, that was what I was going to ask you next. Is there any probability or chance that they drop a 1/2 point in September, or is that very unlikely? Guys, before we finish up the conversation today, there's one thing that Mark and I noticed that's super concerning. Most of you that watch our videos are actually not subscribed to the channel.
Why would you want to miss out on great conversation like this?
If you're getting value out of the conversations that Mark and I are having, a subscribe to the channel helps us tremendously. We are on the road to 1,000 subscribers, and we're getting closer every day. And guess what? If you don't like us, you can always change your mind later. Now back to the content.
It's very unlikely because they're old and slow. I shouldn't say that, right?
Yeah.
But really, it's funny. Trump calls him too late Powell, right?
Yeah.
And so there's certainly a feeling about that. But
not one of Trump's best nicknames. I feel like he could come up with a better one for Powell.
Yeah, he's been more creative with others. So I was a little disappointed with that one. But anyway, he, they are conservative by nature, and probably that's a good thing. Because, you don't want them to all of a sudden drop a point because it throws the whole market off.
Yeah.
Now you got pandemonium, and you don't want it that way. You want it a slow progression. Yeah, exactly.
A point before the, midway part of next year would be meaningful, right?
Yeah.
That would likely drive mortgage rates into the I mean, potentially low 5s, right? I mean, that would be kind of what we'd be looking at. And
yeah.
We said, I was the one who famously said that anything in the 4s gets the market kicked up. But that was like, in fairness, I was still riding the high of 2021.
Right.
I think now it's more realistic that's like things really heat up in the 5s.
And aren't you a millennial anyway?
Well, I'm 88, so I don't even know what that makes me. But
I don't know.
I didn't have a smartphone for the first half of high school.
Okay.
So that's how I define it.
Yeah, I get it. So, but no, in all seriousness, and really the market is adjusted. Like when we talk to people about rates are too high, I'm not buying a house. Okay, well, how high is too high? How low? What's low?
Yeah.
Almost nobody's saying 2% or 3% anymore.
Yeah, everybody's kind of past that.
Yeah, they figured out like that's not likely to happen. Once they get back to 4%.
2% during COVID times is like your ex-girlfriend that you didn't want to break up with that still texts you from time to time. You feel like one day we may get back there. But now it's been like 2 years and she blocked you on Facebook. You haven't heard a word from her. And like, yeah, you're not getting that back ever again. Not in this lifetime.
That's an interesting analogy.
Yeah.
Does your
you.
wife watch this show?
Probably
sorry.
not. I mean, if she does, probably the first 30. She's bad for our click-through rate. We start talking mortgages and yeah.
It's okay. She's changed the locks by now anyway.
Exactly.
So you're good. We have an extra bedroom if you need it. But in all seriousness, I don't think we're seeing 4% next year. Because it's just realistically, rates in the sixes are not bad historically. It's okay. It's just we have this mental thing with rates. Yeah. It's got to be, 5 or it's got to be. So, yeah, I think we're solidly in the 5s.
Yeah, I think the problem is it's not the percentage. Like the percentage is what people hang on to.
Yeah.
It's rates in the 6s plus home prices being higher than they've ever been, plus insurance prices being higher than they've ever been, plus taxes being higher than they've ever been, especially in a state like Texas. And then you combine all that together for a whopping mortgage payment, and people are like, oh, those damn interest rates. But it's like, that's not the whole equation, And
I may get some comments on this one, which is, hey, I welcome it, whatever. But, COVID sort of caused a lot of those things. If you think about it, home appreciation hasn't been as plentiful, as sharp, as rapid as it was after COVID.
Yeah.
Because everybody and his mother was buying a house.
Yep.
And so there was high demand. There was lower inventory, because of the high demand. And so there weren't a lot of houses, there were 5 offers in every house.
Yeah.
Now, we didn't have the inventory problem we have now. We had enough kind of to go around, but we were still short just simply because of the demand.
Yeah.
Right. And so that drove up the values, which drove up the taxes, which then, a lot of people were sitting around their house going, man, I need to get this done. I need to get that done. So now we need, we're making insurance claims and what do you think increased the insurance rates? Mm-hmm. It's the claims, it's the cost of materials that went up. Like all of those things became more expensive.
Yeah.
And so, had COVID not happened, maybe we wouldn't even have a memory of 2% rates.
Yeah.
But we might also not be in the same situation we are tax and insurance wise.
It's so true. Like I told so many people when those, stimmy checks, as everybody was calling them, the $1,200 was just landing magically in their account. I think most people got like 2 of them. And so it's like $2,400 and everybody's like, isn't this great? And I'm like, it feels great right now, but I promise you, you're going to spend way more than that $2,400 in the increased cost of goods. Because that money just came out of thin air. So by definition, it devalued the dollar. So the inflation follows. Mm-hmm. And think about how much more you paid for all your grocery visits, gas, eating out, whatever the heck it is you like to do. Yeah. You ate through that $2,400 and then some in most people's case.
And the reality is then they got used to a higher standard of living that was artificial.
Yeah.
And so that's why also we're seeing more consumer debt, credit cards, personal loans, that sort of thing. Things from personal loan companies, and not to name any names, but, there's certainly companies out there that will loan you $500 or $1,000 or do a payday loan or whatever. We're seeing more and more of that every day.
That's like the Klarna type.
Yeah, and the Klarna, that's a whole nother thing. Klarna, and there's several companies like that will do, you want to buy a, $80 pair of jeans. Yeah. Well, you can split it into 4 payments.
Yeah, my grandparents called that layaway back in the day. But when my grandfather used to go to what he referred to as the Sears Roebuck, and I don't know who Roebuck was. By the time I came around, that was off the end of it. But that was what he called it until the day he died.
It was a company that merged, and anyway, that's a whole other
Roebuck
story.
Yeah, hey, but he would say, like, we would walk past it, and I was a little kid at the time, and he was like, that's the layaway window. Like you pick out what you want and it's going to wait right there behind the window until you pay it off. And it's like, that's basically what these kind of like Klarna type products are, right?
But one difference.
What's that?
With Klarna, you take it home with you.
Well, that's right. Yeah.
And so now you have it. So now you want something else.
Yep.
And then you get and pretty soon we've got 7 or 8 Klarna accounts, and then you apply for a mortgage, and we're trying to figure out like, well, wait a minute, how much do you owe on these things, and how long? How do we figure that in the debt to income ratio?
Yeah.
Whole other subject, but the point is it's a different world.
Maybe that should be another video, because I've had a couple of clients that have had to pay off some payday loans, and there's one, I think it's called Earn In or something like that. One of my clients was like, the lender, and she was buying new construction. So you're always looking for like whether or not I'm, feeding business to other lenders. So I always like to caveat.
We call that cheating on them.
Yeah, exactly. I like to caveat if they're going the new construction route that's offering like crazy rates here in Houston. But the lender told her that she had to pay those earn-in things off before they could approve the loan, which is interesting.
Yeah, it's happening because it creates a problem. So, but again, we could talk about that on another video.
Yeah, I think so. I think that's the perfect place to wrap it today. The Jackson Hole meeting seems to cause some excitement, so we'll see what happens next.